Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. Looking at the UK economic data today, it is easy to despair. The IMF is forecasting we will have the weakest growth in 2023 among the world's 15 largest global economies, and that even includes Russia. Almost 475,000 union members joined strikes yesterday in the face of a government that has little budgetary flexibility to meet their demands. After all, UK taxation as a proportion of GDP is already forecast to reach its highest level since World War II. In the charts that follow, though, I will argue there are some real economic positives which are easily missed. Among them, the rising value of Britain's foreign assets, the robust position of UK mortgage holders, the transformation of the balance sheets of UK banks, and the remarkable turnaround in pension funding. So why is this important to us as global managers? Well, primarily because of the impact on sterling, which despite all of today's challenges has actually rallied strongly from the lows reached after the Trust's budget fiasco. In the slides below, we will argue this recovery in the currency can continue for some way yet. As the Bank of England rate-setting committee meet this week, they're probably looking at very similar slides to the one we have on the first panel. They'll look at UK inflation, 10.5%, an extraordinary number, but beginning to roll over, 6.4% at the core. Now that's of course forcing unionised workers to go on strike to try to protect the real value of their own wages. And you can see the bottom panel, the surge in work days lost to strike action. That number, by the way, will rocket higher once we include the February figures. What can the government do about it? Well, from a taxation position, relatively little, because the OBR chart here on the right shows that the tax take as a percentage of GDP at somewhere around 38% is already at a post-World War II high. So what does all this mean for sterling and the value of the international portfolios you hold at Saracen? Well, if we look at the sterling trade-weighted index, that's sterling against its major trading partners, you can see a long-term decline over the last 40 years. But it hasn't come over that whole period, it's come in terms of reaction to political shocks. The collapse of the pound following the ERM crisis in '92, the fall after the great financial crisis in 2008, the fall after the Brexit vote in 2016, and finally the decline to 107 to the dollar following the fiasco of the Trust Quarteng budget. So where are we going from here? Well, we think, as we've seen in that chart, typically after a crisis, the pound gradually claws back a large portion of what it's lost. And this is what we think will happen today. Why are we so sure? Well, there are 4 key reasons. First of all, in the Bank of England Stability Report, they've shown the international investment position of the UK. That's our assets abroad versus assets of foreigners in the UK. That blue line has gone from broadly in balance to a net surplus of almost 100% of GDP, sort of like a wealth fund, and that's a very big number. How has that grown? Well, investment has increased, but primarily values have risen as equity prices have climbed, and of course the fall in the pound has flattered those numbers. That's a very defensive position for the UK in the longer term. The second piece of good news is the debt service ratio, that's the proportion of an individual's income taken up by credit card interest payments and crucially mortgage payments, is much lower than in previous crises. So even if we push up interest rates further from here, the pain to households, although significant, won't be anything like what we saw in 2008-9 or in 88-92. So more robust household balance sheets and income levels. Thirdly, of course, the strength of the banks has been utterly transformed since the great financial crisis. I've showed you in this chart in those blue bars the capital ratio, that's the amount of equity held against risk-weighted assets for banks, which has risen from 4% during the crisis of 08-09 to almost 16% today. An incredible achievement of the regulators, leaving the banks extremely robust, even in a deep downturn. Fourthly and finally, something extraordinary has happened to UK pensions. I've shown from Mercer here the retirement plan deficits and funding levels for the FTSE 350. Now you can see a year ago those were sharply in deficit. But 2 things have happened. One, corporate bond yields have risen. And secondly, sadly, I'm afraid as a result of COVID, longevity rates have fallen. Put them together and extraordinarily we've moved from a 76 billion deficit to a 35 billion surplus. That's the best I've seen our pension funds looking in the 38 years I've been in the industry. So what does this mean for the pound? Well, we argue that despite all the challenges today, these hidden pieces of good news mean that sterling can continue its rally up from those lows we saw in September. What's our target? Well, we take the purchasing power parity rate, that's the theoretical level sterling should reach, and that against the dollar is somewhere around 130 to 135. If we reach that level, we'll begin to reconsider our hedges and your overall sterling positioning. So what could be the trigger to this further rally? Well, I think one thing's critically important. If Prime Minister Sunak can manage to reach agreement with the EU and the other parties over the Northern Ireland Protocol and use this as a trigger for a new trade relationship with the EU, I think the opportunities are quite exciting. So the trigger in the next few months could be a political breakthrough. Thank you so much.